Welcome to Revere Asset Management's Your Money with Danny Stewart
The market will always overshoot to the downside and to the upside.
and Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
When a couple of clients ask, why don't you have a lot more cash, or even ask us to move to cash, or even prospects or people that follow us, that's normally a contrarian signal. They're normally wrong. Not always, but they're normally wrong. You got to follow the charts. Price is truth, no exceptions, period. Now, the markets may actually be entering in a power trend. Do you know what that means? Do you have any idea? And you should not follow the headlines. People are scared because of headlines, the Iran war, the oil spiking. But the markets are still resilient, and they're still strong. And the headlines are meant to scare you. But the hedge funds, the big, huge hedge funds, they're already ahead of the game. In fact, when the news comes out, it's already priced in. There's an old adage on Wall Street. It's called buy the rumor, sell the news. Now, we don't just buy the rumor because it's got to be confirmed by price, and the stock's has to start going up on strong volume. So let's go to the team and Obi-Don Kenobi and find out what the markets are actually telling us. But first, I've got a mailbag. It said, this is from MB. He's a client, 422, and it says, Turbotection rocks. Today it boosted my 1.3% Grotection return to a total portfolio return of 1.64 for Grotection and Turbotection combined. And then he put up a couple AI. He's got into this AI. He makes these AI little thumbnails. Hopefully Don's got one up there. But then he said, Turbotection Titans, who are you going to call when there's a gremlin in your portfolio? Don, do you have those up there?
Yeah, I'll have it in 1 second.
Okay. They're classic. They're truly classic. And then Don responded back, the tortoise and the hare. The good news is they're both winning the race. One is just a little less volatile, and the returns are a little bit lower. But Turbotection is a little more volatile, and the returns are higher. Now, here's the thing, though. They're both still much less. They're both much less risky than the state. Say that 3 times fast. They're both less risky than the S&P or the stock market, or even a 60-40 bond, balance fund, in my opinion, because we have a strong sell discipline. So when the market goes into a correction or bear market, we're either hedged or that's when we really go to cash. Not right now. Anyway, let's go to Don and see what, oh, there it is. That's classic. I like that one right there. Anyway, let's go to Don and the team and see what the markets are actually telling us. Don?
They're actually telling you that they want to go higher. And that's not something we just say in a blasé manner because they've gone higher. It's looking under the hood, what the leading stocks are doing, what the indexes are doing. We've seen people just absolutely petrified with this. We know some people that are following gurus that are promising an epic crash. And that's just unfortunate. It's horrific. Unless you're on the team that's going to detonate a dirty bomb in Manhattan, that's the only person that you could listen to about that a big crash is coming. There are so many fear sells, furus out there that embarrass themselves time after time with ridiculous predictions, and they drag people along with them, unfortunately. But look at this. look at this chart of the S&P 500 and look at it objectively. Here, we're going down. We're not making a prediction while it's going down. We are watching it break our short-term, our medium-term, and our long-term moving averages, and we react accordingly. We don't predict. Then 3.5 weeks ago, we started going up. That's not an opinion. That's a fact based on a reclaim of the 8-day, a reclaim of the 21-day, a reclaim of the 200-day, a reclaim of the 50-day, an 821 cross, a 2150 cross. All of the moving averages align the way we want them, and the market making all-time highs. I mean, what do you do with that except follow it? Price is truth. There's a reason why Dan says it 175 times a week, because it's an answer to so many questions. What if? Well, what if? But what if? Well, we've got all the what ifs covered because we've got stops on every position that we have. We got completely taken out of the market at the lows here. And it's okay to be wrong. It's not okay to stay wrong. The very next day, we gapped up and we started buying back in because our first signal to get back in is a reclaim of the 8-day exponential moving average. Did we know that this was going to take a rocket to the upside? We did not, but we know that you got to start somewhere. We know we were very stretched to the lows. We know that we pierced our bottom range the same way that we did in April of 2025. The difference was that then we went down another 10%. Right now, and in this case, that was the bottom. So what can we do? Well, we're going to underperform off the bottom. That's part of the process for paying for protection when you're down under this black line, which is historically where all bear markets occur. But we didn't do that. We went higher, and we bought leading stocks and leading sectors along with index allocations, and we're riding this wave now. Now, I could be doing this video next week and telling you that we're back to being 50% in cash, and that wouldn't be based on an opinion that we're going to crash. That would be on an objective measurement of what the market is telling us. On the other hand, we could be sitting up here around 73, 7,400. And again, that's what we're positioned for right now, is to simply ride the wave, ride the 8-day higher, ride the 21-day higher. As long as the 8 is above the 21, we're in fantastic shape. We had a power trend on the NASDAQ 100. With a positive close today, we'll get a power trend on the S&P 500 confirmed. It's a tentative power trend turned on. You just need an update to confirm it. And I don't want to oversimplify it, because what we do isn't easy, but not arguing with the market is what it boils down to. We've banned the phrase, I think, from look at all these upside alerts firing off. That's telling us something. It's telling us that the market is strong. We're at an all-time high right now as of 8 minutes before noon on Friday, 4/24. What do you do with that? You should be very heavily invested, and we are across the board. And it's a matter of riding the leading stocks. Ted and Connor have done a fantastic job in Turbotection, getting some nice leaders on in size. And Growtection is kept it down about 1% behind the S&P 500, but closing the gap because, and this is something I talk about all the time, when the market is in a strong uptrend, you have to be over-invested. That's where we are right now. We're just waiting for our names to provide that additional catch-up to the indexes. When you're in a bad market, you want to be under-invested. When you're in a choppy market, you want to be about in balance with a beta of approximately 1 while the market figures out what it wants to do, whether it's going to go above the 200-day moving average, break down and get back above, or break down hard. Everybody's calling for a breakdown hard. The Strait of Hormuz is still closed. The market's at all-time highs. The market is looking forward. The market is anticipating that this is going to get resolved, and it's going to be good for stocks. It's going to be good for the economy. It's going to be good for earnings. And earnings going higher is what drives the stock market higher, and then you apply a multiple to what the earnings are, and that's how you come up with what the S&P 500 is doing. Anybody saying that we're just going to automatically crash to 5,500 because they think so is assuming that all of those earnings reports that are coming out are showing massive potential drops in earnings. And that's not just happening. That is the simplest way to laugh at people that are telling you that we're going to crash. Because if earnings keep going up in the S&P 500, the market is going to keep going up. And we're seeing no indications that earnings are falling off a cliff. The market is pricing in higher prices. We're getting higher prices, and we're riding those higher prices higher. And anything else is just screaming into the wind because you're wrong. You're just wrong.
Speculation,
okay to be wrong, but it's not okay to stay wrong. When we were down here and all in cash and we started to go up, if we'd have stayed in cash, we're wrong. And we also would have been staying wrong. And we just don't do that. We've got 6 technicians on staff that it'd be curious if one day I just played a joke and said, you know what, guys, we're just not going to follow what the market's going to do. I think we're going lower. I don't want anybody to buy anything. How would that go over in our team meetings? I mean, these guys would probably know that they'd be looking around for a hidden camera thinking they're getting pranked, because that's just not what we do. We just don't argue with the market. When you take care of the downside, the upside takes care of itself, and the gains will take care of themselves. And your account goes higher when the market's in an uptrend. That's the grow part of Growtection. And we protect it when we start breaking these key moving averages, and completely protect it when we get 2 ATRs, but that's average true range, below the 200-day moving average. One of the main things we've been watching for now, one of the keys in our videos every night when we do the tail of the tape, it's just the 8-day moving average as support riding the indexes, and all-time highs at resistance. And in addition to that, we want to see the average true range of the S&P 500 start dropping. And we've seen that for 4 consecutive days now. That means the ranges are getting tighter. All of this fear that was in this drop on the left side of this V shape has been dissipated. We ideally want to get the average true range down to a 1. The VIX is currently at 18.6, which is a little over 1.1% projecting on the ATR and the S&P over the next 30 days. We're good with that. We want it under 19. Ideally, we want it to get down to 16. Dan, that's what the market's saying. That's what we're doing. And it's, as Ross Perot said, it's that simple.
That's right. And that was a good explanation. I don't have any comments on that, Don.
You're kidding me. You
I
have no
don't.
comment?
Yeah, you explained it so well this time that nobody more surprised than me.
Man. All right. Along with that market overview, we have got, as usual, 3 tremendous presentations for you from Ted, then Connor, then Todd, and we're going to turn it right over to Ted right now. I want to bring up an ETF first before he starts, because I don't want to confuse some people. Growtection is long WGMI. This is called the CoinShares Bitcoin Mining ETF. And 2 years ago, it was a bunch of tickers that were Bitcoin miners. Then Bitcoin did its halvening, whatever you call it. That meant the cost to mine Bitcoin doubled, and all these Bitcoin miners saw the opportunity to pivot to their big data centers that were doing Bitcoin mining, and they could host AI on all the infrastructure that they got, that they already had built out. So it was a very smart pivot. Basically, every single one of they should rename this ETF. WGMI stands for We Gonna Make It. That is a term by the Bitcoin bros, Bitcoin culture. It's named WGMI. They really should rename it for what it is. But the bottom line is it's chock full of solid names that provide the infrastructure for AI data centers. And Ted is going to talk about a couple of names that are in here, and he's also going to talk about a couple of names that are not, that are big compute / data center builders. Take it away, Ted.
Yep. So OpenAI posted a few days ago that they were looking to build 10 gigawatts of compute, or capture 10 gigawatts of compute this year, and they're at about 8 gigawatts. And they also posted a chart, an exponential chart. Oh, there it is. Yep. That they're looking to acquire or generate over 30 gigawatts of compute by 2030. And this is just one company. There's massive demand for compute. You can add in Anthropic, Amazon, Google, XAI. XAI is their Colossus 2 with like 500,000 equivalent of H100s. Pretty much, compute is what fuels artificial intelligence. Without compute, and then behind that is without energy and compute, there is no artificial intelligence. And we know there's this huge AI revolution happening in the background right now. AI agents pretty much just started earlier this year and late of last year. And this theme is just really getting started. AI agents are being improved. Companies are coming out with better agents, better models to support these agents. And so the theme and thesis here is quite simple. You have a basket of stocks, a lot of the WGMI names, and as well as NBIS and CRWV, which we'll talk about, that just have a bunch of data centers, locations, land, and existing infrastructure already set up with GPUs where companies can rent out or borrow some compute. So the first one, let's talk about NBIS. I talked about this. Actually, this is starting to really set up like that MSTR precedent that I talked about many weeks ago. We broke out into all-time highs. Now, there's about 100% move, and now we're really starting to flag. We broke the 8 EMA today, but ended up holding 150. We're still figuring out exactly when earnings are. I'm not sure if it's confirmed for next week, but some sources say it's next week. Some sources say it's in May. We'll have to wait for the company to officially announce that. But this is setting up a perfect
until they post it on their website, it's speculation.
Right.
On when their earnings are. Yep.
My speculations of the last few weeks is starting to come true. It's starting to build this high handle here. We're starting to get really interested in it. Turbo owns a position of starter right now, and we're just looking to add on to it as well. I'm not going to dive too deep into the difference of the companies. For us, how we frame this is that these companies are part of the compute theme, and we use our technicals, momentum, relative strength, and entries to just get involved. The next one is CRWV. This one had a huge correction off highs, and it's still in the lower end of the base, which makes me think that NBIS is the better opportunity if you just look on pure technicals and relative strength, because NBIS is at all-time highs, while CRWV is still, how much they're down from, they're still down 40% off highs. So what that means is there's still a lot of overhead, but they did have a highest volume ever day, which does help reduce some of that overhead. And you can see the ANTS indicator started flashing, which is a sign of institutional accumulation. This is another one. This, NBIS, Irene, these are probably like the big three in the compute area. So now Irene, if you can draw that downtrend line, you can either do on the daily chart or weekly chart. We're just poking our head out of this huge downtrend line and this huge range. Relative strength is making higher highs here. It's in the 90s and it's trending above all Q moving averages as well. This is a name that is part of WGMI. If you look at those estimates on the left-hand side, there's triple digit in earnings, really nice revenue growth as well. So this is another name that we own in Turbo as well. The next one is CIFR. Oh, Don brought up WULF, which is also in WGMI. The reason I don't like this one as much is because you can look at the base in this move. It's so choppy. So we rather pick the more linear stocks. CIFR is another one we own in Turbo. You can see 98 RS rating, and then this relative strength line also broke a huge downtrend line and started to build higher lows and higher highs. This is building a handle-ish pattern under 20. So we're just watching this potentially make some more ads over 20. But these are higher ATR stocks, so we don't want to oversize and get shaken out on a normal reaction. And then the final one I want to talk about is APLD. Yesterday, they actually had a news event. They entered in a lease agreement with a new US-based hyperscaler for 430 megawatts for an AI factory. Again, that's just the theme. These data centers, you can call it data centers, but Jensen Huang actually said that's probably more of an old term back in the cloud computing days when the internet kind of first started in the 2010s, where data centers just stored a bunch of data. But now the better term to use is actually AI factories, because you have the energy layer, you have the chips in there, you have the network and the optics, you have the memory, cooling. And so this whole building and system is what produces artificial intelligence. And that is pretty much the thesis. And we're just going to ride the wave in these names. They're climbing up the right sides of their bases. And we've talked about big weekly bases, big monthly bases often are indications of newer themes, because why does a base form after a big move? It is institutions accumulating stock off weak hands while they support the stock. So I think Connor is going to also be talking about a huge base that we've nailed in Turbo as well, and the CPU theme.
All right, thanks, Ted. Let's turn it over to Connor, and let's start off with a nice winner that we trimmed into extensions on Turbo today. ARM. Take it away, Connor.
Yep. So I'm going to do a trade review on ARM and just kind of walk you guys through the process that we used in Turbotection. So firstly, if we start at the monthly chart, and this is kind of looking at the longer term time frames is kind of what got the idea started. So everyone remembers ARM from a couple of years back. It had that extremely powerful move. And then after that, it's been in a big range for nearly 2 years. And again, we don't want to own stocks in big ranges. We want to own stocks as they're coming up the right side of the base and breaking out of the range. And typically when stocks show previously that they have the ability to make super strong, powerful moves, they tend to do it again. And that's exactly where Don's showing right now. I mean, that was a incredible move on ARM. It was short, but it just showed how much power. And then go to the weekly chart now. And the weekly chart just again displays the base, very choppy until it isn't, once it starts to break out. So that was number one. Saw the huge base, and that is what got it, on our radar and our attention. And then number two was just the underlying theme. The big driver in some of these semis right now is CPUs. CPUs are pretty much the new trade, and I'm not going to go into detail on this, but people are speculating that CPUs are in short supply, and this is what's been driving a few of these individual names. And then if you go into the daily chart, this had a catalyst with highest volume in 1 year. And on 325, ARM gapped up on the highest volume in 1 year. And the catalyst was ARM unveiled its first ever in-house AI chip, ARM AGI CPU. And then the CEO projects, 25 billion in annual revenue and $9 EPS by 2031, with 15 billion coming specifically from that AGI CPU compared to only 4.9 billion expected. So, that catalyst kind of caught the street off guard. You could see it in the volume. And then after that, it did, exactly what you like to see. Some of these catalyst names, you don't have to buy them on day one, but you don't want to lose track of them. And that's typically what happens is, gapped up and then it went quiet. And so on 4/7 was the initial entry into ARM, and that was at $143 a share. And simply, it was just a nice hammer off the 21 EMA, low risk on a pullback, and that was the first buy. And then again, thing that we're working on as a group at Revere is pyramiding into winners quicker. And so 4/9 was another pyramid buy. This was just a tight inside day hold, and this add again was higher. We don't average down, we add on to winners. So the second pyramid buy was at $149 a share. And then the last buy was 4/16 at $162 a share. So again, 12 bucks higher, adding into a winner. And this was just when it started to get through that high volume close. And then as you can see, it's just kind of started to go parabolic. And today was the first trim, 13 ATR extended above the 50-day moving average that it triggered today. And again, the 10 ATR plus above the 50-day are more reliable when a stock has, extended from the base, as ARM is really just breaking out into 2-year highs. But again, it was the biggest position in the portfolio, so it is always prudent to sell some into strength, and then it's easier to hold and manage it on the down days. And then just to add conviction into this one, pull up a chart of AMD. This is another name moving on the CPU theme, and just incredible move. Up another 15% today, and then Intel. This is why all these names are gapping up. Intel reported earnings yesterday after the close in the same CPU theme, and it's up huge, over 20%. So, extreme strength in this group, and ARM was the way that we played it. Intel, if you've been watching our videos, we own this couple times in Turbotection, just never could get it to stick. But glad we were able to capture ARM for this theme. So that was just a trade review on ARM, just kind of walking you through the theme, the base, the entries, and exits.
Excellent job, Connor, and excellent job for clients on ARM in the portfolio. Turn it over to Todd now, a sector that starting to get back on our radar, solar, and start off with the ETF TAN. Take it away, Todd.
Thanks, Don. Just want to point out that solar really doesn't have any catalysts going on right now. There's been no government news, no earnings, beats and raises, nothing like that. But it is showing up on our radar screen. And let's start with the weekly chart to see what this thing's done and what's happening right now. And maybe if you could just spread that out just a little, there you go. Not really any, it's had a little bit of an uptrend since April of last year, and it's setting up into its first flat base here, almost exactly a 15% flat base. And what I find unique about this situation is starting with the week of 320, it's put in a 5-week tight. That's where it's traded extremely tight within around 1% or less every single week. And this was during a pretty volatile time where, the S&P was going down a couple weeks in that period. And now this week it's starting to cross above that 5-week tight area. So let's look at and it's also happening on some pretty decent volume. So let's go to the daily, take a quick look at that. And you can see where it had that really nice bottom candle a month and a half ago off of that establishment of this 15% flat base. And it's just been getting really tight. And then all of a sudden on Wednesday of this week, we saw above average volume and then some follow through yesterday on above average volume. So that really is some accumulative action and may or may not work. This is not the easiest ETF or area, and it is receiving possible benefits. Data centers are extremely power hungry. You could argue that all forms of electric generation are going to be on the table, with solar being one of them. Going through the components of the ETF, the number one holding is NXT. And NXT by far is probably the best looking chart of the components in the ETF here. It's coming up into that resistance area again, so we'll keep an eye on that. This particular component represents about 12% of this ETF. Really, the only other major one that trades any type of volume that looks good in this is Solar Edge also, SEDG. And that also had a nice pocket pivot yesterday after, pulling back from that big cup base it failed to break out from. So Again, down a little bit today, but trading inside yesterday's bars on both the TAN and these individual components. There's a whole bunch of smaller volume components in here. A few of them are looking good also, but we wouldn't necessarily trade them. These are the top two names that look good in that ETF. And just, to get out of the technology area, this is an idea that we're looking at.
Good stuff, Todd. Dan, let's go back to the S&P 500 for one more peek.
Okay.
How's that look? Looks like all-time highs to me. And one of the problems where if you didn't get in on the initial follow-through day, this has been kind of a lockout rally in some names, but you can see yesterday the index pulled back perfectly to the 8-day exponential moving average. That was an extremely low risk situation to get into the S&P 500. A stop a little bit below that or down to the 21-day moving average, which a test over the next couple of weeks down to the 21-day would be completely normal. 3.5% above the 21-day right now, but we're seeing a nice little 6-day consolidation through time since we made that first big all-time high on 4/17. So resting for 5 days and now moving out today. Nothing bearish about that, Dan.
That's right. Remember, I told you at the beginning, some people were scared. So once the market has a pretty big rally, then they get FOMO and then they want to get in after the fact, and then you get a little pullback or maybe a big pullback. So you got to follow price. Listen, folks, if you like what you heard, please tell a friend, tell a neighbor. Just go to revereasset.com. Up in the right-hand corner, there's a subscribe button. This podcast will go directly to you. Actually, on Saturday, we send this out on Saturday, and we do a nightly market update and even inform clients and prospects exactly what we're doing in the portfolios. We're the most transparent advisor in the world. You can also go to YouTube and just search for Revere Asset. And if you hit subscribe, Zach, our producer, he'll have this on the YouTube channel by Friday at, Central Time at 1 or 2. And you can always call us old school at 855-REAL-WEALTH. Thanks for listening on Your Money, not Wall Street's money, your money.
So it's not about how much you make in the markets, it's about how much you can keep.